So I'm gonna explain credit spreads, and there's two main types of credit spreads. There's the first one is a bear call credit spread, and a bear call credit spread is the selling of a call and the buying of a slightly farther out of the money call using the proceeds of selling the call. And I can in the next slide I'm gonna use a diagram to show you how that actually works. So it's okay if you don't understand that. But usually naked sold calls have an unlimited loss potential because you'd have to buy the stock at a certain price times 100 shares, no matter how high it goes up. So you could lose infinity times 100. And since you're buying a call with the proceeds, you're reducing your risk potential. So let's say the current market price is $225 of stock X. And then you're going to sell the 250 strike call with 10 days till expiration. That's what DTE means, days till expiration, at 350. But since options trade in contracts of 100, that's times 100. So $3.50 times 100 is $350. So you receive $350 of credit for selling the 250 call with 10 days till expiration. But then you're going to use $250 of the proceeds of that to buy the 255 call. And they have to have the same expiration. If they don't have the same expiration, it would actually be a different type of option strategy. They have to have the same expiration or else it won't work properly also. But so you're going to intake a credit of $100. So the way you're going to calculate your max loss is the width of the spread minus the credit received. So the width of the spread is 255 minus 250, which is $5 times 100. So if I bought the 260 call and I sold the 250 call, since there's $10 of gap and times 100, I'd have to put up $1,000 of collateral for that trade. And then but in this case though, my max loss is $500, but you have to add on the credit received, so it's actually a max loss of $400 because you're intaking $100 of profit when you place the trade. And the way it'll work is you're going to receive $100 of cash, and now you own this credit spread, which has a value of negative 100, and you want this to expire worthless. You want it to at expiration, it will have a value of 0 if it never hits 250, but you will slowly begin to lose $500 the whole way, beginning from 251 actually, because that would be your break even, because you received $100 of credit for this trade. But how much credit you received, once you start breaking into that, after you surpass that, then you break even, and then you go through the spread, and as you go to 255, you hit your max loss of $400. As if it closes at 255, and it doesn't matter if it goes above 255, doesn't matter how far, you will still be paying $400 no matter how far above 255. And on top of that, if it closes at 249.99, it's the same thing as it closing at 225 at the day of expiration at close, because they will expire worthless either way, and you'll still win. So what is a bull put credit spread? That's the reverse. So the last time we wanted something to not go up, but if you want something to not go down, like you're bullish on it. Oh, last time I said bear. Usually if you're bearish on something, you want it to go down. So before we wanted it to go down, we wanted to not hit a certain price that was up there. Now we're bullish in the stock. We think it's going to go up. So we're going to say there's a certain price it can't go below, and we're going to create a credit spread down there. And a put credit spread is the selling of a put, and you got to buy further out of the money put using the proceeds of the latter put. And usually naked sold puts have a loss potential of the stock falling to 0 times 100 shares because it's an options contract, but you're going to use the proceeds to reduce loss potential. So I'll show you what that looks like. Let's say the current market price is 250, and then you sell the 225 put with 7 days till expiration at 350, and then you buy the 220 put with 7 days till expiration because they have to have the same amount of days till expiration. You're gonna sell the put and receive $350 of credit, and you're gonna buy it at $250, and then you're gonna receive $100 of credit for placing this trade again. And again, it's a $500 wide spread. So if it closes, the market price closes in between there, you could be exercised and lose some of that money. But if it closes anywhere below 225, you get to keep all of the profit. But the whole time the trade is going through, they hold all of the collateral. Your broker always has to do that. Why would you trade credit spreads? Because they have a high probability. You can be wrong and still win. So let's say I wanted the stock to go up, and it goes down a little bit, but it only goes down a little bit. My initial belief was that it was going to go up, but it went down, but it didn't go down that much. So it didn't never crossed my price at expiration. So I still won, and I still took all the money. And theta or time decay is actually in your favor. Usually options are assets that are losing value exponentially, but since you're selling them, they're actually going to be gaining value exponentially. And you also set your loss. You can't lose anymore. The only way you could is if the dividend comes, and I believe if it's selling a call credit spread and a dividend comes, there's a chance you could be exercised for the dividend. That happened to me one time, but I believe that's kind of rare. Why would you not want to trade credit spreads? Because they have a limited amount of profit, and you also might look at the risk reward amount and be like, that's not something I would want to do. I'm now going to show you how to place a credit spread on Robinhood. So go to AT&T and you would hit trade AT&T options. So this would be the option chain that expires the 9th. So I could come in here, and then let's say I want to create a put credit spread. I'd go to the puts, and then see how right here it says break even. As soon as I change this to sell, it changes to chance of profit. So you always want to look at the chance of profit on the options you're selling, and you ideally want to sell like 80%. So let's say I'll sell the $25 put, and then I'll come down here and I'll buy the $24 put. And here, luckily, there's $1 wide options, but sometimes they'll go in increments. Like Apple will be at they'll go in increments of $250, like that, instead of $1. And then obviously that'll mean you have to put up the respective collateral. But if I were to come in here and I want to sell a put, sell 250 put, then buy that. So then, and if you look actually up here, if I were to sell calls, I probably could actually do a $50 wide spread, because they allow that up here. But it's just once you go further down the option chain, they don't have options. So that's a $100 wide spread. So you hit continue, and you'd now choose how many option contracts you want to put up here. So if I were to put up 75, because why not? It would give me a credit. I'll make it a more reasonable number though, so it looks real. So if I put up 10 credit spreads though, if there's a $100 wide spread, I have to put up $1,000 of collateral for this trade. But if I placed it with a limit price of 12 cents, or $12, I should say, per contract, it would give me $120 of credit, and then I could place that trade. But you have to remember though, when trading options, if you've ever traded options before, you know that every option comes with a bid and an ask, and you got to keep that in mind, because you're selling this option to someone and you're using the proceeds of it to buy another option, and then usually options always have a spread on them between the bid and the ask. And then as you can see right here, the spread on this is really high, and it's usually hard to trade things with high spreads. So you actually, to get this filled, it's very possible you might have to come closer to the bid. And I do that a lot when I trade credit spreads. I can't get them filled, so I just keep replacing the order. So what you would do is you'd place the order, and if it doesn't get filled, you could decide if you want to replace the order, or if you want to wait until the options market gives you the right opportunity. Because sometimes the option just eventually moves the right way, or the stock moves the right way, or whatever happens, and then it gets filled. But you also just have to pay attention to how quickly these options are moving, though, and how big the bid and the ask are, and also how tight it is too. And then it's more easy to get filled the more activity there is on that. But just keep replacing the order until it gets filled, and then you can monitor your put credit spread once it gets filled, just like any other asset. And then if it starts to actually get into your zone, I always recommend selling, because you don't want to take that max loss, because it's a lot of money. And as you can see for this, if I'm only receiving $120, $120 is not worth $1,000, and I could pull out taking, let's say if it's initially worth negative 120, I could get rid of it for negative $400 a couple of days down the road if it keeps going down, but at least it's not $1,000. You gotta think of it like that. That's worst case scenario, but you always just, because these are such high risk trades, you have to really be managing your risk, and really apply the proper stop losses, and make sure if it breaks pattern or is going the wrong way, you have to be smart with your investment. And that's why credit spreads are a little more dangerous, I'd say, than trading options, because obviously because of the higher loss potential. But if you enjoyed the video, please like and subscribe for more. Good luck trading, and have a good day.